guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe. The US economy will need tight monetary policy for some time before inflation is under control, a fact that means slower growth, a weaker job market, and some pain for households and business. Federal Reserve Chair Jerome Powell said on Friday in remarks warning there is no quick cure for us fast rising prices. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation. They will also bring some pain to households and business, Powell said in prepared remarks for a speech to the Jackson Hole Central Banking Conference in Wyoming. Sandra Holdsworth, head of Rsi UK at Aegon Asset Management. Chairman Powell spoke today at Jackson Hole where he maintained and reiterated the hawkish stance the US Federal Reserve is taking towards the current high levels of inflation. In a short and concise speech, he made several points. Firstly, that the economy was still showing strong underlying momentum and that the labor market in particular remains out of balance. Second, that interest rates will continue to rise to a restrictive stance and importantly stay there for some time, partly because the Fed views it will take time for inflationary forces to decline, but also because in previous inflationary episodes it was a mistake to relax policy too early. In short, the speech was hawkish and we would expect yields of government debt to continue to rise. Stephen O, global head of credit and fixed income, co-head of leverage finance, Pinnacle Investment Los Angeles. Powell's short but direct speech was focused on delivering a message to the market to reset expectations for a longer period of maintaining tighter monetary policy conditions in order to successfully combat inflation. He provided a historical context and justification for the need to maintain levels once the current cycle peak is reached and indicated the Fed's willingness to do so even in the face of a recession and rising unemployment. So the headline summary is that we are getting closer to the peak, but we will plateau for an extended period prior prior to any potential path downward. Simon Harvey, head of FX analysis, Manix Europe, London. It was pretty much in line with what we're expecting, and that's even though they don't want to give forward guidance. They are going to try and guide markets to the idea that they're going to slow down the pace of the hiking cycle, but they're going to offset that with the idea that rates are going to be restricted for longer, and that was what was stressed within the actual statement. That duration is now the preference having a longer period of tighter monetary policy as opposed to, continuing front loading is it at the expense of potentially having to cut rates in the future. I don't think markets necessarily priced this correctly to begin with. This was a speech for his legacy because this Fed has been tarnished for its stubborn, transitory view of rising inflation, which was exacerbated by a perception that Powell couldn't be thought enough to do what's necessary to expunge inflation from the economy by invoking to the work of other Fed chairman Volcker, who have had to deal with inflationary pressures. Powell made it clear how we want to be perceived as a Fed chair who restored price stability in order to restore a strong economic foundation. Salman Ahmed, global head of market and strategic asset allocation at Fidelity International, London. Okay, that's all for me. Thank you for watching. Don't forget to like, share, comment, and subscribe. Thank you.